In this week's video, we'll review the latest charts to help us answer the question, ongoing stock rally or Fed-induced pullback? Got a tremendous amount of material to cover. Feel free to use the pause button on your video player. You may remember on July 16th, we covered the topic that it's very hard to get a real theme in this market because of the rotation between growth and value that's been taking place under the surface. We've also seen recently an extremely rare disparity between the performance of SPY and RSP, the equal weight S&P 500 ETF. The only other times that we've seen something similar was under bearish conditions after the market had already peaked. Remember last week we talked about the big decline in lumber after the big run-up. And remember we said that told us to keep an open mind about inflation expectations possibly being too hot for the second half of the year. And as you can see in the upper left-hand corner of your screen, we're not alone in thinking that's a possibility. Also noteworthy, maximum fear about inflation may have been hit in the month of August with record inflows into the TIPS ETF. Cover these charts many times. As of August 12th, nothing alarming here. The trend break is the look that we want to avoid relative to the stock market. We've recently been printing higher highs. It's always important for us to keep an open mind about better than expected outcomes and worse than expected outcomes. This indecisive look that we covered last week was still in place as of Thursday's close. The trend break look is what we want to avoid here. We're getting a bullish breakout, which is almost the binary opposite at this point. Really, everything that we said about the last chart applies to this chart. Also noteworthy, NASDAQ 100 up-down volume. This is before the COVID plunge in 2020. You can see the stock market, things didn't go particularly well in the lower right-hand corner of your screen. But notice, look how far the indicator was extended from the prior base, which is back here in this blue box. How does a present-day chart look? Better, worse, or about the same? At this point, it's somewhat indecisive, but relative to being extended from a base, much, much better. Here's consolidation back here and a breakout. The market rallied in this area here where my cursor's moving around. Right now, this looks like consolidation followed by a bullish breakout, and we're still holding the long-term trend off of the March-April low from 2020. As always, those comments are related to the chart in front of us as of August 12th. We'll learn something either way. Mega cap NASDAQ 100 relative to the NASDAQ August 12th. We're still moving above the 61.8% retracement, which tells us it's possible this was a counter-trend move within the context of a long-term uptrend with this chart going back to 2013. An updated version of the chart that we covered last week, still from a long-term perspective, looks like a counter-trend move at this point, still indecisive down here. Sometimes consolidation resolves itself in a bearish manner. At this point, August 12th, it looks like this multi-month period of consolidation on the weekly chart is trying to print a new weekly closing high. Based on the look of this chart, it's hard to make the argument that this is a bearish development. Similar situation here in terms of the market having potential support in the rearview mirror. Even if we saw some type of pullback, a lot of sideways consolidation in here that began in the March-April timeframe, and a lot of areas of potential support. If you're a client, you may have wondered, why have we locked down so many gains year to date? And it seems like we've been making a lot of allocation shifts. It's a daily chart of VTI, the total stock market, so broader than SPY, VTI relative to SPY. Here's the COVID low in March of 2020. We consolidate here, and then there's a big move and a breakout that starts, for the most part, in earnest in early November of 2020. From this point walking forward, your leaders are small caps, mid caps, industrials, financials, and energy. We had rotated to some of those areas in here and had some wonderful gains up here in Q1 of 2021. And then things shifted dramatically, starting really in February, March, depending upon what market or sector that you're looking at. That leadership shifted in a big way. In fact, for the most part, all of the excess gains from this point here in November of last year were given back when VTI-SPY hit this low here. We're in a bull market. Why wouldn't we just assume that all of these are going to lead again in the future? To answer that question, let's specifically look at small caps. This is VTI relative to SPY. You can see IWM, small caps relative to SPY, basically the same situation. If you own small caps here, wonderful things were happening. If you held them from this point to this point, for the most part, you may have lost all of your gains in here. Again, why not just hold IWM? This is a bullish trend. This is probably a counter trend move within the context of a bullish trend. Well, A, look at price relative to the moving averages here. Price is above, for the most part, all of the moving averages, and the slopes are turning up. That's almost the binary opposite of what we have today. Price is below all of the moving averages, and for the most part, they're all rolling over. So this is one time frame here, and let's think of this in the context of what we talked about last week, counter trend moves and primary trends. So if we look at small caps IWM relative to SPY, how does the longer term trend look? Is it up or down? Based on what we know this week, and this is being recorded during Friday's session on Friday, August 13th, late in the session, unequivocally, it's a downtrend. Here's a high, this is a lower high, this is a lower high, and this is a lower high. This is a lower low relative to this low, this is a lower low relative to this low, and this is a lower low relative to this low. As always, we're not saying that's a permanent condition, but in order to hold small caps, we really need to see more here. So this is small caps relative to the S&P 500. If we flip it around and look at the S&P 500 relative to small caps, this is an uptrend. The primary trend is up, and right now we came back and for the most part held this uptrend and started to rally. So back to the original questions. Why would we lock down those gains, and why have we made so many allocation shifts? Because what you're hoping here is that this primary trend is going to change in small caps relative to the S&P 500, but that's not what we've seen. If we flip it around, it's pretty clear to see on the monthly chart with a 50-month moving average that the S&P 500 is still in a primary uptrend relative to small caps. The same thing can be said for the S&P 500 relative to the equal weight and the S&P 500 relative to mid caps. So if we just assume that we should hold IWM in here when it's falling rapidly on a relative basis, even though it just looks like consolidation on the chart of IWM in isolation where my cursor is, this is the relative performance relative to SPY. So instead of helping us as it did here, if we just blindly hold it, there's really no proof in hand yet that this move in this direction has ended, and it's going to continue to just be a drag on the portfolio. Think of it this way. When IWM is in a long-term downtrend relative to SPY, when it starts to underperform here where my cursor is, we don't know if this move here is similar to this move here or similar to this move here. And what makes a primary downtrend helpful is if you keep holding IWM relative to SPY in a primary downtrend, it's going to continually be a drag on your portfolio, a drag. Even worse here, even worse here, worse here, and even worse here. Until proven otherwise, and we make decisions based on the facts in front of us, we need to see more from IWM. That doesn't mean we won't see something like this. A primary downtrend, absolutely positively yes, it can flip to a primary uptrend. That may happen soon, but it hasn't happened yet. Here's another way to look at it. RSP relative to SPY on August 12th. This is the primary move here from A to B. It's a downtrend against RSP and for SPY. That's the primary trend, the stronger trend. This move here from September of 2020 from A to B, until proven otherwise, that's a counter trend move. This is the downtrend from A to B. We moved up into this area here and stalled and reversed between the 61.8 and the 38.2. And that's what fibs help us with. This is a 100% normal and to be expected counter trend move within the context of a bearish trend. From a probability perspective, if you can clear the 61.8, the odds of a trend reversal start to increase. And once again, that absolutely may happen. It hasn't happened yet. Once again, this chart's August 12th. During the session Friday, early, 10 a.m., RSP was once again underperforming SPY fractionally. Bottom line, the chart on Friday looked a little bit worse than the chart on your screen. This is still an indecisive look here. That's one of the reasons why we still own some RSP. It's still possible that it's going to hold in this general area and go on to make a higher high. Here's another relevant question you might have as a client. If this isn't a primary downtrend, why would you even mess around with a move like this? Typically, we would not. But at a major low, sometimes your leadership shifts. Why would you do it? Because after a major low, sometimes RSP can significantly outperform SPY. This is after the major low in 2009. RSP performance in red, SPY performance in blue. This is well worth the risk-reward ratio to deal with some of these headaches in here short term. Something that's extremely important here, during this period of outperformance, eventually in here, you get an improved look on the longer-term charts of RSP relative to SPY. This is the type of improving look that we would want to see in the present day. The ratio above an upward sloping 50-month moving average. This is 2015 on the right side of your screen. This is 2015 here. This is still what looks like a long-term uptrend favoring RSP relative to SPY. How does the same chart look today? We just don't have it yet. Here's the answer. Here's the period of outperformance that we would hope to participate in here, but we just don't have it yet. And you can see there was a pause here, but this is a little pause. This pause looks a little bit worse, and RSP needs to prove something. We don't want to hold on to something that's in a long-term relative downtrend or have significant exposure to it relative to SPY. Not making any assumptions about whether this chart takes on a look like this going forward or a look like this going forward. We'll see how it plays out. And in that context, it's pretty easy to understand the rationale for 1 and 2 here, to protect and grow our capital. The goal is to be overweight in ETFs that are in long-term uptrends relative to the S&P 500, giving us a probability of capturing market returns, or hopefully even better than market returns. Something that's in a long-term downtrend relative to the market is going to increase the probability that we perform worse than SPY. In a lot of these cases, we're talking about IWM relative to SPY or ratio charts, RSP relative to SPY. We could use any number of ETFs that were involved in what now appears to be, at the present time, a counter trend move within the context of a longer-term downtrend. These are just basic trend concepts. They apply to SPY in isolation. They apply to IWM in isolation. And let's assume when this starts to happen, you just ignore it and you hope that good things will happen, and eventually this will reassert leadership. Well, in the context of a primary downtrend, that can be very, very dangerous. And while we do not believe a 2007 to 2009 move in the S&P 500 is imminent, these concepts apply to relative charts as well. This is SPY here. This is 2007, January of 2007. This is October of 2007. We're in a primary uptrend here. So if you basically say, this is a counter trend move, I'm going to hang in there, good things happened. This is a counter trend move or volatility to ignore within the context of an existing or established uptrend, good things happened. But you can't assume that any trend, a relative trend, a ratio chart, a chart in isolation, is always going to remain in a primary uptrend or primary downtrend. So let's say right here you said, I don't need to do anything here. It's going to be fine. See, I told you, everything's fine, just like this point here. There's no need for us to do anything here. This will be fine. If we're just patient, everything will be great. See, I told you. Good things come to those who wait. Well, this is not that big a deal. It's just a little bit of a lower low here. It looks like this momentum is dissipating. I'm just going to hang in there. See, I told you that was the right thing to do. If you'd taken action somewhere in here when you made that first lower low, you'd be in better shape than you are here. Now you're making another lower low. This is a low, this is a lower low, another lower low. Now this is starting to look like a primary downtrend. Oh, we'll be fine. Everything always comes back. See? It did come back. Patience is a virtue. This is what happened next. Well, it's got a bottom now. There's nothing I can do. See, hanging in there, that was the right move. No, it wasn't. A lot of times people get angry when they see a chart where SPY lost 55.19% under buy and hold from point A to point B. Well, one of the reasons why you might get angry is because it makes you feel uncomfortable. It makes you realize you don't have a game plan if something like that happens again. And this isn't anything fictional. This is a fact. If you held SPY from this point here to this point here, you lost 55.19%. And these exact same concepts apply to ratio or relative performance charts. And this here is how some people can hold a long-term loser relative to the market for long periods of time. Oh, it'll come back. See, I'm right. It'll come back. I'm right. But this is a primary downtrend until proven otherwise. The same concepts apply to equal weight relative to the S&P 500, mid-caps relative to the S&P 500, energy relative to the S&P 500, industrials relative to the S&P 500, and the list goes on. And if you paused your video player and read these quotes, for the most part, given what we know today, these concepts are really more applicable to relative trends based on what we know today, but they're still relevant. And the purpose here is not to say there's anything wrong with buy and hold. You just have to make a decision. Are you comfortable with that? Are you comfortable with the S&P 500 losing 55.19%? And for those of you that are always asking, are we beating the market or keeping up with the market? You can beat the market from point A to point B by losing 54%. So if we're comfortable losing 54% of our hard-earned money, then we could be comfortable with long-term buy and hold. If you're not comfortable with that, then you really need to come up with a game plan to address it. That's personal choice. There is nothing wrong with buy and hold. When markets are printing new all-time highs, it's pretty obvious that eventually, as far as history goes, it comes back. The question is, relative to your age and your net worth, do you want to go through something like this again? And that's a personal choice. There's no right or wrong answer. And maybe dollar signs sometimes hit home a little bit more. So let's say we held from point A to point B. We were 100% invested in SPY. We went with a low-cost alternative, tried to keep our fees low, and lost 55%. This table tells us if you started with $1 million at point A up here, and you held SPY in the real world from point A to point B, your $1 million would have been worth $448,000. That's not really hypothetical. That's what happened in the real world. So right now, it is blatantly obvious the S&P 500 is in a long-term uptrend until proven otherwise, and has potential support relatively close by if we see a 3 to 5 to 8% correction. And during Friday's session on August 13th, IEF relative to SPY remains in a downtrend until proven otherwise. It looked like it was trying to make a turn in here, but it could not complete step 3. Once again, we're not predicting anything with this chart. Trade the chart in front of us. This is the chart in front of us on August 13th. You can pause your video player here, or better yet, Google this title. You can find this Bloomberg article. You're probably going to be reading a lot about liquidity because the Fed possibly will be removing some liquidity in future months. Just be careful with an analysis that errs on the side of only being bearish, and that's not the case. This Bloomberg article is well written, gives both sides of the story. It notes, from a liquidity perspective, when this happened here and this happened here, bad things happened in the stock market. 16% correction, 19.8% correction. But relative to this chart, we should also keep in mind, last week we talked about a bullish development in the present day that tied us to January of 1995. Well, this scary event that happened here that you can read about in the article, and this scary event that happened here also happened in 1995. Once again, tying the present day to 1995, telling us to keep an open mind about much better than expected outcomes. Covered this many times, stocks versus bonds. This was the look on August 6th. Better, worse, or about the same this week? The answer is quite a bit better. At least we broke this downward sloping trend line on August 12th. Still need to clear this high here decisively. Hasn't happened yet. How about tips? This was the look here, the lower high look that we wanted to avoid when the S&P 500 had an intermediate term peak here in 2010. Really don't have that here. We made a higher high here recently in July and an even higher high again in August. Covered this slide last week. Indecisive look, tech versus bonds. Also noted when the correction came in 2010, this trend was broken in favor of TLT against XLK. Similar situation when the stock market started to get a little bit dicey in early 2004. Clear trend break. If we look at the same chart on a weekly basis during the session on Friday, August 13th, the weekly chart is already printed in the rearview mirror in July, a new high, and it's trying to do the same thing again this week. This here, this bullish breakout from consolidation, really doesn't look anything like this, and really doesn't look anything like this. Caveat, here's a bullish breakout and it failed, helping us keep an open mind. We trade the chart in front of us. If we get a failed bullish breakout, we'll learn something under that scenario as well. Long-term chart we covered last week. This is SPY relative to TLT. For the most part, this goes back to 1999, somewhat of an indecisive look near this prior high after a multiple year period of consolidation. So again, this is SPY TLT from a longer-term perspective. You can see it's in a primary uptrend. This is the 50-month moving average. The ratio is above an upward-sloping 50-month. Still has some work to do here, as we mentioned previously, but it has shown improvement in recent weeks. Friday, August 13th, Friday the 13th, nothing particularly scary or ominous on the chart of the VIX, which is making a series of lower highs, possibly going to make a lower low, but that's to be determined. Here's the long-term chart. If we flip it TLT relative to SPY, you can see on August 4th trying to break above this downward sloping trend line. But if we fast forward to August 12th, this trend line here, price now, is right on this angle in the lower right-hand corner of your screen. And here, the ratio is below a downward sloping 50-month moving average. This is looking more like a false breakout that occurred during the COVID plunge. Remember, this was the indecisive look on the longer-term chart that we covered on August 4th. That even looks improved on August 12th. And as we mentioned last week, it's very, very difficult to get overly concerned about the market when XLP relative to SPY is making new lows. Contrast this look over here on the right side of your screen with this look here. This is where the S&P 500 peaked in October of 2007. The ratio was already rising and soon thereafter cleared the 50-month moving average, and then it turned up in favor of XLP and against SPY. This is a scared defensive type look. We really don't have anything like that in the present day. And you could look at this chart and say, well, it's about to turn. Well, we could have said the same thing here, 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 we could have said it here, we could have said it here. It is possible it's about to turn. But we don't trade about to. We trade the chart in front of us. Right now, this is the look of the chart this week. Another thing that's noteworthy, let's flip this one around. This is XLP relative to SPY. If we flip it, SPY relative to XLP is breaking out of a 14-year consolidation box. The ratio was basically at the exact same place recently as it was back here in 2007. This is increasing fear. This is the rear view mirror in the present day. The longer we hold above this point here, the better it is for stocks. We know three things have to happen before the S&P 500, even short term, can flip into a downtrend. We don't even have step one during Friday's session on August 13th. What could upset the bullish apple cart? All of the information that we've covered. Three letters, F-E-D. Jackson Hole coming up August 26th to 28th. We could spend 4 hours talking about what the Fed may or may not do. Remember, we focus on what we can control. This helps us keep an open mind about worse than expected outcomes. You pause your video player. A lot of the information that we have in front of us, the facts that we have in hand, charts, data, ratios, asset class behavior, tell us to keep an open mind about a stronger than expected finish to the year. It's important to remain open to a wide range of outcomes. Pause your video player. Chart on the left will help you do that. The chart on the right says, you may say, we've been up a lot already in 2021. Well, typically, similar years, it wasn't over yet. The market continued to rise into year end. So how do we handle all of this? The same way we always do. Head into next week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.